Have you ever thought about a single piece of software that keeps an eye on a huge chunk of the world's invested money? We're not talking about a government program or some big stock exchange. Nope. It's a machine, and honestly, its influence on the global economy is just almost impossible to overstate. Okay, let's get into this. Just look at this number for a second. $21.6 trillion. That's more than the entire annual economic output of the United States. And as of 2020, that's the value of assets being watched over by one single electronic system, a system that, most people have never even heard of. So that really begs the question, doesn't it? What kind of machine could possibly be powerful enough and trusted enough to sit right at the center of so much of the world's wealth? Well, the answer is a system called Aladdin. To really wrap our heads around its power, we first have to get what it actually is. And believe me, it's not just some fancy spreadsheet. It's way more complex and, predictive than that.
Okay, so its full name is a bit of a mouthful, Aladdin, which stands for Asset, Liability, and Debt and Derivative Investment Network. At its heart, it's an incredibly sophisticated risk management tool. Its main job isn't to pick the next hot stock, but to spot all the hidden dangers in any investment portfolio, before they turn into total disasters.
So how does it do it? This is the really cool part. Aladdin basically tries to simulate the future. It scoops up a ton of historical data and then uses this method, called a Monte Carlo simulation, to generate thousands upon thousands of possible future scenarios. Then it stress tests a portfolio against all of them. What if there's another pandemic? What if the housing market crashes? Or interest rates suddenly spike? By running through all these what-ifs, Aladdin paints this incredibly detailed picture of all the things that might just go wrong. But a system this powerful doesn't just pop up out of nowhere. Its story is really one of failure, of crisis, and of the slow, steady rise of an empire that's built not on money, but on information. And you can really see that journey right here. Aladdin got its start in 1988 on a single computer, literally tucked between a fridge and a coffee machine. Its first big break came in '94, when it somehow managed to untangle this notoriously complicated mortgage portfolio. By 2000, BlackRock figured out that other companies needed this tool too, so they started licensing it out. But the real game changer? The 2008 financial crisis. When the whole global system was basically melting down, who did the US government call to sort through the toxic assets from places like Bear Stearns and AIG? You guessed it, BlackRock with Aladdin. That moment just cemented its place at the very heart of global finance. And here's the unbelievable backstory to all this. BlackRock's founder, Larry Fink, he was the star bond trader back in the 80s. But then a sudden shift in interest rates made his models completely fall apart, and his firm lost $100 million. That failure taught him that the biggest danger wasn't just losing money, it was not understanding risk. And that painful lesson? It became the entire philosophy behind Aladdin. It's just incredible. The guy who was once destroyed by risk created the machine that would be used to rescue the entire global system from it. But this kind of incredible success, this centralization of power, it leads to a very serious and very tough question. Right. With so many banks, pension funds, even entire governments all depending on this one piece of software, critics started to wonder, has Aladdin, and by extension BlackRock, become systemically important? Like a piece of infrastructure so critical that if it failed, it could trigger a whole new crisis all by itself. So let's break down the concerns, because there are a few. First, you've got a single system that holds a digital map of global finance. Then you have competitors who are actually paying to use that system, which could potentially give BlackRock some serious insights into their strategies. And during a crisis, you have governments leaning on this private company's tool to help manage public policy. It all comes down to this one question. What happens if the one tool everyone is using breaks? This concentration of data and expertise is just unprecedented. So does relying on one single point of view, one single model for what risk is, does that actually make the financial system safer? Or does it just create this massive hidden vulnerability that no one's seeing? Now, of course, BlackRock has a very clear and detailed answer to all these worries. They argue that comparing them to a systemically important bank is just a fundamental misunderstanding of what they actually do. Back in 2015, they actually wrote a letter to financial regulators laying out their whole case. They basically said that this whole idea of them being too big to fail like a bank, it just doesn't apply because their business is built in a totally different way.
And this is the key to their argument. Look at banks on the left. They use their own money and taxpayer-backed deposits to make loans. If those loans go south, the bank itself is on the hook. But asset managers, like BlackRock, they're on the right. They act as agents. It's not their money. The client's assets are legally separate, held by a totally different company called a custodian. So if an investment tanks, it's the client who bears that loss, not BlackRock.
This quote from their letter really gets to the heart of it. BlackRock is never on the other side of their clients' trades. The money is completely walled off legally speaking. They argue this structure means that even if a huge asset manager were to fail, the solution is simple. The clients just hire someone else. So their whole argument really boils down to these key points. 1, risk comes from specific activities, like using tons of borrowed money, not just from being big. They think regulators should focus on those activities across the whole market. 2, the industry is super competitive, and if they were to vanish tomorrow, clients have plenty of other choices. And 3, labeling them too big to fail wouldn't solve a thing. It would just push the business and any potential risk over to a different company. So we're left with these two fundamentally different ways of looking at this incredible machine and the company that built it. And here you can see the two core arguments just laid out side by side. On one side, you've got the concern. Centralizing all this data and influence creates a single point of failure and makes a private company essential for public policy. And on the other side, you've got the rebuttal. Hey, we're just an agent, we're totally different from a bank, and risk should be regulated at the market level, not at the firm level. Which brings us to the core paradox of it all. Is Aladdin the ultimate guardian? A stabilizing force that uses data to see and prevent crises before they even happen? Or has it become a black box, so complex and so central to everything that its own unforeseen failure could become the very trigger for the crisis it was designed to stop? And that's the bottom line, really. When you give one single machine the ability to see almost all of the risk in the entire system, have you actually made the world safer? Or have you just created a single point of view, making everyone blind to the one risk that the machine itself can't see? That is the trillion-dollar question at the very heart of our modern financial world.